Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0, News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is February the 13th. This is a late night video. It's not that late, but late enough for me. I got to go to sleep soon. I got early morning, guys. I'm doing a lot of work on properties the past couple of weeks. That's why I've not been doing the video. Sometimes work takes precedence over stuff like this. But anyway, a lot of real estate on the go. I guess you could say I've looked at, I see changes in the marketplace. I've looked in the past, 2 days, about 20 plus off-market properties, single family homes, duplexes, quadruplexes, multifamilies, fix and flip, buy and hold. You got it. You name it. We kind of got access to it, which is kind of cool. And I guess one of the things I want to mention, if you've not inquired about this type of stuff, please do so, because I actually have put together, which is kind of neat, which I guess you could say I'm kind of announcing right now. I've got kind of a turnkey package set up here where we've got access to financing, which is basically purchase, fix and flip, buy and hold, the whole bit. We have lenders that I work with that can sort of, I guess you could say, finance a lot of people. Yes, of course, you have to qualify, but there's a lot of financing these days for rental properties, for fix and flip, etc., which is kind of cool. And that's why the things are starting to change again, which is kind of cool. And I'm seeing a lot of price reductions in the off market. But the whole point is, if you're looking for fix and flip, if you're looking for buy and hold, if you're looking for multifamily, we have access to it. We can find you the properties. We can secure them for you. I've got, we can get the financing with working with our partners. Have that set up with you as well too. I've got, I guess a rehab crews that can rehab them for you. We basically know how to manage the projects. We can find renters, or we can sell them for you in the end. It's a whole turnkey package here. So something you'd like to inquire, please send me, drop me a line, an email at my email. Give me your phone number so I can text you, and we could talk about this. Also, if you're looking for more investment opportunities, especially in the short sale marketplace, which is an untapped marketplace. That's where all the inventory is right now, people. So give me a shout as well, too, and we can get you hooked up on that. So basically, the whole point is I'm seeing a lot of stuff right now that's going on in the marketplace. So what does this kind of mean? Well, I think ultimately in the end, we see a lot of potential people who are selling. People always have to sell. I do see a lot of, we'll call it investors, who are doing what I call normalization. So if they've got a portfolio or a pool of, I guess, properties, they're looking for maybe properties that possibly aren't margining for them, or just not interesting to them. They want to get cash out and prepare and build some cash for the next crisis, and that's what we're experiencing right now. So I do have a lot of people who are selling some properties, and they're normalizing their operations, which gives us opportunity to move them to other people as well too. So it's kind of a cool situation here. So anyway, again, a fair warning here. This is going to be a longer video. Reason being, I haven't done a video for about 2 weeks now, and I apologize for that. But just again, busy. Sometimes work takes precedence. Moving properties, working on properties, getting stuff set up for clients is what I got to do, and that's what takes precedence sometimes. This caught my eye today. U.S. household debt soars most since the crisis in Q4 amid explosion in new mortgage origination. So guess what? Household debt balances have been steadily increasing for the past 5 years. And basically, we hit a new peak. And the household debt balance is really credit card, student loan, auto loan, other debt, plus a mortgage. So we're at the peak of debt in our history, I guess you could say. Basically, we're 26.8% more in debt than we were back in the trough, which was in the 2012-13 area. So where we are today, we're more in debt than we were back down here about 5-6 years ago. Now, a big thing, of course, is mortgage originations, including refinances, increased significantly in the final quarter of 2019, with auto loan origination also remaining at the brisk pace seen throughout the year. Mortgage originations jumped to the highest volume seen since Q4 2005. So we're talking what? We're talking about 14 years, and we're back up to we'll call it first housing crisis mortgage origination volume, which is kind of interesting. And I just wanted to, basically say a lot of it is based on refinances. So if you take a look back in history, just before we had our housing bubble crash situation, we saw a surge of refinances. A lot of them are cash out refis as well too. So please keep that in mind. When we talk about mortgage origination, just the blanket term just means new mortgages. They don't specify how many are refinance based versus purchase mortgages. So we'll talk about that some more. Another article says mortgage lending just had its biggest quarter in 14 years. Federal Reserve Bank of New York shows that the mortgage lending experienced its biggest quarter in 14 years. According to the New York Fed, there were more than $750 billion in new mortgages originated in the last 3 months of 2019. So last year, fourth quarter last year, $750 billion of new mortgages went out. That's, again, more than any quarter since 2005. And it's stark reversal from the first quarter when we only saw $344 billion in mortgages. So obviously there seems to be a little more push. Is it because of low interest rates? I would have to say that's the deal. And again, much of the growth in originations was due to a large increase in mortgage refinances. They don't exactly say what is purchase and what is a refi. I would hesitate to guess a lot of it is refi based. We know from MBA, which is Mortgage Bankers Association, when we look at the weekly stats, there seems to be a lot. They're always talking about 65% of originations or their applications are refi based as opposed to purchase mortgages. There you go. Now, compounding all that problematic stuff with respect to low mortgage rates means you want to either refi because you can't buy a house because U.S. inventory of homes for sale reaches a record low. Supply shortage is choking the housing market and driving up prices. So the nation's inventory of homes for sale tumbled 14% in January, falling to the lowest level since 2012, according to a report from Realtor.com. And where it really is, I guess you could say, most difficult and where we're lacking inventory, of course, is the supply of properties priced under $200,000, which is affordable housing. So basically, the inventory of entry-level homes saw the steepest drop that, in the series that goes back to 2012, the report said. The supply of properties priced under $200,000 fell 19%, while homes priced above that declined 12%. So that's where we're really seeing the lack of supply shortage right there. And obviously, the shortage is evident by December's 4.9, almost 5% drop in pending home sales, the largest in almost a decade, according to the National Association of Realtors. So there you go. So the metro areas with the largest annualized inventory declines were San Jose, down 37%, Phoenix, Arizona, down 35%, and San Diego, down 34%. Only 2 of the nation's 50 largest metros saw inventory increases. Minneapolis up 9.4%, San Antonio up 8.4%. So there you go. Mortgage rates inch up slightly from a 3-year low. Now, because we've had a couple of weeks since my last video, in between the last video and today, a lot of discussion on mortgages, and a lot of it was the fact that the instability in the economy due to the government issues, due to the coronavirus, the nervousness of investors with respect to that part of the economy. So mortgage rates dipped a little bit, and they became they were low. They were basically 3.47 last week. 3.45 last week. They inched up to 3.47 this week. That's a 30-year fixed mortgage on average, with mortgage rates hovering at a 5-decade low. Refinance application activity is once again surging, rising to the highest level in 7 years. This surge, coupled with strong purchase activity, means that total mortgage demand remains robust, reflective of a solid economic backdrop and a very low mortgage rate environment. So there you go. So mortgage rates are up slightly, but it's still much, much better than this time last year. Excuse me. So interesting here, because we're looking at opportunities with respect to what we can purchase out there. 45% of homeowners are planning to move in this next decade by 2030. So Lending Tree did a survey, and the survey revealed that 45% of homeowners plan to move within a decade. When asked why they're moving, well, 30% said they would because of a lower cost of living. 28% want to move to a city with better job prospects, and 21% want to be closer to their children, which makes sense. Also, another 42% of renters have plans to buy a home for the next 2 to 5 years, and 16% said they'll start the home buying process next 6 to 10 years, and 25% of the renters surveyed said they're never going to buy a home. Simple as that. No plans to, won't bother. Simple as that. So interesting enough, and again, this is based on the fact that not all home buying experiences have been great, and especially with low inventory, with competition, etc. I guess people and the thought or the impression or the realization that you're overpaying for a property, not getting what you think it's worth, that's a problem as well too. So again, people are moving, and we'll see how this matches up to the other, other part of our, I guess you could say, demographic, which, we talk about, or the media talks about, the silver tsunami, the baby boomer generation. So maybe when these 45% of homeowners are planning to move during this decade, it'll coincide with the fact that boomers will be selling their homes, and we'll have a nice meeting of the buyers and sellers. That'll remain to be seen, I suppose. Okay, next, moving on here. Just so you want to know how much housing we need. Well, basically, this was put out by Realtor.com. It says housing market falling short by nearly 4 million homes as demand grows. And why they say 4 million homes is they say, well, 5 million single-family homes built between 2012 2019 do not offset the 9.8 million new households formed during that time. So we have homes that are being built over a period of time, and we have household formation. So really, it's almost, we're 5.9 million homes. These are new homes being built. Cannot, I guess you could say, satisfy 9.8 million new, I guess you could say, household formations. That could be, your children leaving the nest, going for their first apartment, or your a new family. Who knows? People cohabitating, getting married, having kids, whatever the deal is, doesn't matter. But the whole idea is that our formation of households does not equal, or the need does not equal what's being built or what's being constructed out there right now. So keep that in mind. Even with an above average pace of construction, it would take builders between 4 and 5 years to get back to a balanced market. Simply put, new home starts not keeping pace with demand. Home builders have a mountain of opportunity, but a big hill to climb, which is true. Now, the demand, which is significant, we don't know, or they don't specify where is that demand? Is that demand in the affordable housing segment, mid-tier housing? Who knows, right? So that's what it doesn't sort of specify. So just keep that in mind. Builders are building homes that are, with a median price of over $300,000. That, of course, is $100K plus more than the $200,000 ceiling, which we would call affordable home price point. All right, another thing about the mortgage rates here. Mortgage rates fall to the lowest level since 2016, but this could be the last affordable spring home buying season for a while, Realtor Group warns us. So here we go. If I flip this over here, and again, I just talk about this because of I guess you could say the last affordable spring home buying season, the title here of the article. So could this be the last affordable spring home buying market? The rising demand is expected to speed the start of the spring home buying season, which generally is the most popular time of year to purchase a home in most of the country. A new report on research from, guess who, Realtor.com, said that buyers who manage to score a deal this year will be lucky, as experts predict that affordability will only worsen in the years to come. So the number of metros across the country seeing improvements to home affordability continues to increase. However, the spring home buying season may be the last to see gains to affordability in quite some time. And again, this is driven by what? Mortgage rates. So we go back to the whole affordability. So for me, a home is priced at whatever the price point is. Whether I can afford it is based on my calculation when I apply for a mortgage. We all know if mortgage rates drop, my affordability has been increased, which allows me to possibly move up in a price point or buy a bigger, better, more expensive home because the rates, are lower. My payments are the same or lower, but the price point is nebulous at this point in time. So that's the kind of fun that we have to deal with here. So basically it says here, other factors play a role, including growing household incomes, decelerating or falling home listing prices, and inventory increases in some markets. So there you go. So, but again, so realtors basically are saying, go out and buy a home right now because it's only going to get worse, people. That's what these people are saying to us. This is kind of an interesting article I read here. It's about HELOCs. If you don't know what HELOCs are, it's HELOC. HELOC stands for Home Equity Line of Credit. So the whole point is that banks are trying to sell HELOCs to their customers. And the HELOC is kind of like you have access to the equity. It's kind of like it's a mortgage, but it's not really a mortgage, it's not really a credit card, it's an equity line. So you may be able to take a potential $100,000 equity line out on your home. It gives you the ability to make draws on that equity line and then the ability to pay it back through a monthly facility. So the point here, though, is that they're looking that HELOCs are actually slowing down. The origination of HELOCs are getting slower because there's not really a demand, which is kind of interesting. And basically in January, HELOC balances at all commercial banks dropped 9% from the previous year. This is the steepest year-over-year percentage decline since 2013. So that's something to note. Again, why do I think it's important here? Well, it's not what's happening right now, it's what's going to happen in the future. All right, so because there are now 128.6 million households across the U.S. That's up 9% from the households that were available in 2008. Okay, everything has grown over the past 11 years: the economy, the population, incomes, consumer prices, and home prices. So the current housing debt in aggregate is actually a bit less than it was back, comparatively speaking. So banks are going, well, we've got all this opportunity, we'll call it the ceiling of equity we can tap into. So banks like the typical Wells Fargo and the national banks and the regional banks are pushing HELOCs, and now the non-banks are pushing their version of HELOCs as well too. So you may find that next time you go to the bank or whatever, you may get solicited to take out an equity line of credit. So really, this all looks good because it's like, well, we don't have as much, we have all this equity that's available, this tappable equity, but not as much debt associated with. Even though our debts are, have risen to records, that spread between tappable equity and debt is still pretty decent. So basically, the bank wants you to take out, or your lenders want you to take out these HELOCs to suck out the equity, and of course now they're lending you money, which is what they do. So everything looks good, but this aggregate is composed of several opposing factors. So basically, what goes on here? Well, many homeowners have paid off their mortgages or own their homes free and clear, which has become more attractive option for households in expensive housing markets. And the reason being too that the mortgage interest deduction has been capped and reduced. So the opportunity to write off your mortgage interest is not is not good like it used to be. So therefore, people are not maybe jumping on the HELOC scene because of that. Many other homeowners are pushing the envelope in terms of their mortgage debt and mortgage payments, struggling to make ends meet on a monthly basis. The concern is if one of the earners loses their job, the entire math of the equation gets in trouble. That could be, that's a concern. Cash out refis have become popular again, and the risks associated with them are increasing to where regulators are now trying to put limits on them. So just keep that in mind. And the home ownership rate has declined as well too. So back when all these HELOCs are being taken out back in the last housing crisis, our home ownership rate was almost 70%. It dropped down to 63%. Now we're about 65%. So, less home ownership means fewer HELOCs. So it's like, these, it's not where it was back in the heyday, but the lenders want to push that opportunity. So again, be aware of that. And why they want that? Because a HELOC is a better debt instrument for them than a credit card. Credit card's unsecured. HELOC is secured against your house. They can grab it. Okay, so that's interesting. Now, during the last housing bust, HELOCs were big contributors to homeowners being underwater with their mortgages, and when they could no longer make their payment, then they found out that they couldn't sell their home either. The foreclosure was the only option at the end of that tunnel. So again, this is just something that, right now it's like, we know about it. It's not rampant like it was back in the last housing crisis, but something to keep an eye on. But the reason why I say this is the fact that it's not a problem yet, but if banks and non-banks are pushing this, eventually people are going to go, yep, I see this equity. If you show me, I may not know the equity I have in my house right now. But if someone shows me, I might go, well, geez, I didn't realize it was that much. Yeah, I should access that money. So banks are becoming much more creative in the way they approach their consumers, their customers, and they're pushing these debt instruments to take money out of the house. Okay, which leads me to another article that came out from Adam Data Solutions, and this was a couple of days ago. So Adam produces a lot of information. This was the, It's fourth quarter 2019 U.S. home equity and underwater report. So it basically shows what we talked about here, equity, shows where equity is at across the board. So right now, 14.5 million residential properties in the U.S. were considered equity rich, meaning that the combined estimate amount of loans secured by those properties was 50% or less of their estimated market value. So your market value is $500,000 and your loan values are $250,000 or less. That means you're top tier equity rich. So 14.5 million properties are equity rich across the country. And that's a lot of properties. But the report also shows, because that's our equity rich properties, and of course there's the underwater properties. So reports also shows that just 3.5 million, or 1 in 16 mortgage homes in the fourth quarter, were considered seriously underwater. And what seriously underwater means is the fact that you actually owe, like your home may be worth $100,000, but you owe 125,000% on your home. So if your home's worth $100,000, you actually own $125,000, for example. I hope the math is right there. But the point is that it's at least 25%, over leveraged based on the value of the house. That makes you seriously underwater. So that's just seriously underwater. It doesn't talk about people who are 1% above to 24%, where they just specify here 25% and above. Now, it's 3.5 million homes are seriously underwater. What does that mean? That means your mortgage is worth more than your house, which means that if you're going to sell your home, there's two things you have to do. You're either going to bring that difference to the closing table out of your own pocket and pay off your lender, or if you're going to sell and you can't make that happen, you do a short sale and you look for some relief from that and that aspect from your lender. So that's the scoop here. Now, this number 3.5 million. I'm to be honest with you, I'm kind of curious on it, and it was about this last quarter as well too when they did their analysis. Now, this number it goes down every quarter of every year since the last housing crisis, because that makes sense. We were so over leveraged, and our values were so low now that things have kind of changed. So this underwater number should be coming down. This is general mathematics. But I noticed that it dropped from a couple quarters ago from over 5 million to 3.5 million. So they didn't talk about the fact that it was a big jump in the decrease in the underwater homes. It just sort of said, oh, we're down to 3.5 million. So I don't know whether there was a calculation change or something happened that they're not really telling us about here. So I sort of go, okay, we're at least 3.5 million. I think we're probably more than that, because we were hovering at 5 million, and you don't go down from 5.1 million to 3.5 million in one quarter. We just didn't earn that much equity over that period of time. And also more and more people are taking money out of their homes. That's going to rebalance some of the equity underwater as well too. So please keep that in mind. Just so you know, if we want to take a look at some of the locations here that top, I guess you could say top the marketplace. I'm trying to find that right now. Looks at the top 10 states with the highest share of equity-rich properties in the fourth quarter were all in the Northeast and West, led by California, Vermont, Hawaii, and Washington, and New York. States with the lowest amount of equity-rich properties were Louisiana, Oklahoma, Illinois, Arkansas, and Alabama. So there you go. Now, the number one location that has the most equity-rich properties was actually San Jose, California. At 65.9% properties are equity-rich. That's a lot of properties. Okay, cool. If we go to the ones with, I'm looking here for the bad ones. Here are the seriously underwater dealios. I guess you say the South and the Midwest led the nation in the more underwater, the seriously underwater properties. Louisiana is the leader. Mississippi, West Virginia, Iowa, and Arkansas round out your top 5. And I guess you could say that the worst locations, cities for most underwater properties are Youngstown, Ohio, Baton Rouge, Louisiana, Scranton, Pennsylvania, Cleveland, Ohio, and Akron, Ohio. So look, we got 1, 2, 3. So 3 of the top 5 are Ohio-based locations. What's going on in Ohio these days, I don't know. Anyway, there's something, food for thought. All right, the rent is too darn high even for middle-income Americans. So a report came out from the Joint Center of Housing Studies of Harvard University. Harvard has a center, it's called the Joint Center of Housing Studies. They do put out reports from time to time that are somewhat interesting. Calculates that 10.9 million renters spent more than 50% of their income on housing in 2018. So basically, kind of like we talked about debt to income ratio with respect to when you're applying for a mortgage, like the DTI, debt to income ratio, is your housing, your housing costs and debt and housing expenses as a percentage of your overall monthly income. Well, there's a limit to that. Well, it looks like, again, 10.9, almost 11 million renters spent more than 50% of their income on their housing expense as renters, which is somewhat shocking. And moreover, there were 6 million more cost-burdened renters in 2018 than there were in 2001. So you can see that the amount of rent or rent increase or lack thereof opportunity thereof has certainly made life difficult for a lot of renters. Renter is cost burdened when they must spend more than 30% of their income on housing costs, and severely burdened when they spend more than half their income on their, I guess you could say, their housing, their rent. So there you go. So we're talking a lot of people spending a lot of money on rent. We all know that rent tags along and drags along with housing value increases. So rent is expensive out there. A lot of rental, a lot of people who are losing their homes or relocating or can't find properties continue to rent, and landlords know that, so that they increase rents or they make the criteria to rent a lot more difficult for certain segments of the marketplace. And we see, of course, the past couple of years have been the advent of multifamily construction booming all over the place, and a lot of that is supplying the rental market as well. So just keep that in mind. I just thought it was an interesting an interesting kind of article that caused the nation's supply of, and they're looking at basically low cost rentals too. That's part of the study here. So basically when you have all this activity, so if you're driving around town, so these new apartment complexes, I guess you could say, being constructed. It's not just a complex. It's got a pool and a workout facility and a games room and a Pilates studio and yoga and all these activities and a lounge area and a bar area. Like there's so much. My son is moving out to start a job. He's finished school, and we've looked at a bunch of these places, and we are astounded at the amenities and the facilities that they are offering. And the whole idea is that by doing so, they're attracting a higher caliber or higher qualified renter, and of course paying more in rent, for some very easy fixed costs. So the issue though is that the lower end rental market suffers. So it's very tough to find more affordable housing. Affordable renting is just as tough to find as well too. So we're seeing a need in that segment of the marketplace. But if you're a landlord, if you can increase rents, make some improvements to your property, increase rents, why would you not do that? So there's not much incentive to keep rents low. And everyone, with all the things changing in the marketplace, you got to keep up with the times, and you need to earn as a landlord as well too. So I get it. All right, almost done here, guys. Just a couple of interesting things. So I read lots of blogs and stuff, and just little snippets of information I find interesting. So, for example, somebody who's a finance expert at the University of San Diego talking about their area, saying if you look at the price per square foot, prices have only risen about 1% over the past year, and he thinks that this is due to the new federal tax law that limits deduction of property taxes, and so the cost of owning a bigger home is more expensive, and therefore it drives down the home price. You don't want to pay for it. Home sellers have to adjust, which is interesting. Orange County Register in California. Southern California had 18,632 foreclosure filings last year. So there you go. So it says, well, bankers do make mistakes and families do have financial catastrophes. So mortgages do go bad even in the best of times. That's a really interesting point I like to make here. So, we talk a lot about how great the market is and how, great from a value perspective. It's not great if you're looking to purchase perspective because you don't want to overpay for properties. But oftentimes the foreclosure information is just not available, or it's very quiet. So I don't really, on a personal note, me finding foreclosure information on the web, it's harder, and less and less people are talking about it. So, it's just, we know that maybe there's Adam puts out their data that says, hey, these counties, have foreclosure filings, but the overall foreclosure, I guess you say foreclosure activity has dropped, and it has dropped, and I admit that. I'm not afraid to say that. Now, foreclosure activity is not just there's parts to foreclosure activity. There is the foreclosure filings. There's the foreclosure auctions, and then there's the homes that are being sold as real estate owned as REOs, repossessions, etc. So realize that maybe we don't see as many REOs being sold and repos by the banks because third-party bidders are buying at the auction, And we see non-performing loans being transferred from banks to hedge funds, and so it's off their docket. But what we don't talk about or see much about is foreclosure filings. So just keep in mind that again, I guess you could say Southern California had 18,632 foreclosure filings last year. So as a percentage of population or properties to those filings, it may seem like a small percentage, but for me, that's 18,000 opportunities to get a home, possibly a distressed home, at maybe a discount price. That's where we should focus on looking for properties. Simple as that. All right. I know that Miami, in our area, in Florida, Miami had a surge in foreclosure filings as well too. Different locations ebb and flow. I know I saw an article today when I was looking at the news, talked about the fact that we had a slower foreclosure quarter for fourth quarter 2019. And again, it ebb and flows with filings. It's seasonal. I know for a fact that foreclosure filings slow down between Thanksgiving and New Year's Eve. I also know for a fact that the government, Fannie Mae and Freddie Mac, often what they do, if there's foreclosure sales scheduled during that time frame, they postpone them until the new year, just because they don't want people to leave their home or be put on the street over the holidays. Not very good public relations. So we find that that could be some of the reasons for a lower quarter. We'll probably see the first quarter jump up. So just something to think about. I just find that kind of interesting, and that's what I look at. That's kind of it. Dallas Business Journal: home price increases in North Texas will likely continue to decelerate in 2020, and fewer homes will sell for above list price as the residential market here, like much of the nation, cools. So what we're seeing, and this is just it's happening all over the place now. So I'm just picking out pieces of information here. But what you're seeing is the fact that the percent of homes that sell for over list price dramatically dropping. All right. So it says down here that in 2016-17, homes selling above list price were the norm back a couple years ago. In 2019, we saw the share of homes selling above listing price about 18% in the Dallas-Fort Worth area. That's down from the peak in 2016, which was about 30%. 2018, it was 24%, so it's been declining. So again, we're seeing this tracking coming down here. Less, people aren't going to overpay. They're not going to overbid for properties because it doesn't make sense anymore. For example, here in Washington, we talked about the fact that the median Seattle condo sales price reduced 4.2% from year over year and 7.7% from the prior month, which is interesting. And what happened is the supply, like people are going, well, I'm just not going to sell my home now. So I guess supply reflects a 1 year and 1 month drop of 32. So 1 year, 32.5% supply drop and a month-to-month drop of 14.2% respectively. So basically, what we're seeing now, if there's reduction in prices, people are going, maybe I'm not going to sell. I'm going to see what the market's going to do. So we're seeing people hedging their bets on selling their home as well. So if you got to sell, you got to sell. You got to buy, you got to buy. You got to move, you got to move. If you don't have to, you may want to. There people are playing the waiting game now and going, okay, I had my home listed. I'll take it off the market and see what happens in the next few months. I've seen a lot of people do that. At the end of the year, they take their homes off the market, wait for a couple of months, and then when the spring selling season comes up, they reevaluate where they are in price point, maybe change a real estate agent, look to refresh the listing, and put it back in the marketplace. So lots of tactics being used by sellers and real estate agents, but in the end, we're just seeing less and less sales activity as a whole. So there you go, guys. So that's it for today. Longer video. I do apologize. I just haven't had a chance to really get into doing a lot of videos just because I've been literally out of the office, looking at properties, staying up late night trying to work through property metrics, talking to people, helping them purchase properties. I'm also working a rehab in a duplex right now. I've been there for the past few days. It's keeping me very busy. So going back to what I said earlier in the video, though, is the fact that great opportunities here where I live. Please reach out to me, inquire about how you can get involved with what I'm going to call a turnkey investing strategy. If you want to participate, you can jump in. If not, we can do it all for you. Great ways to make money with what's going on out there. And as I said, literally in the past 2 days, I haven't even looked at all the properties, that probably 20 to 25 have hit my desk availability. And whereas, 3 or 4 months ago, I was getting maybe 4 or 5 a week if I'm lucky. So things are picking up in the marketplace right now. So that's it for today. Thank you for the views. Thank you for the likes and the comments. If you're not already a subscriber, please hit the subscribe button and help my channel grow. I would really appreciate that. If you'd like more information on what I just talked about, turnkey investing or investment help or buying or selling a house in my area or Florida, please drop me a line. If you're looking to invest in real estate and would like to learn more about short sales and that process, that's what I do. That's what I like to do. That's what I have a lot of knowledge on. So please drop me a line and I can talk to you about the real estate products that I have that can help you do that. So anyway, take care, everybody. We'll look forward to speaking with you in a couple of days.